But part of Bitcoin reaching that level is when more and more entities own it, and it's 5 times larger than it is now. And you can't have like a single like FTX in the Bahamas blow up and then send the price around, affecting everyone's money. So part of the maturation process is that more entities buy it. That'll include small entities, big entities, potentially sovereign entities. Pretty much the whole stack is buying it. If it ends up being global reserve asset and a global reserve money, it basically means everybody's going to own it in some way or another. Now, the path dependence still matters. The ideal, optimal, the utopian scenario is all the little people get in first, then the bigger people come in, and like nation states are last.
Lynn Alden begins with a simple yet impactful statement. Markets are driven by liquidity. Knowing where money is flowing has never been more crucial in light of mounting debt, changing central bank policies, and global instability. Alden draws attention to the paradox that government spending is high despite the Federal Reserve's tightening, which feeds market volatility and investor misunderstanding. Alden looks more closely at structural factors like demographic changes, debt servicing costs, and currency fluctuations than many analysts who only pay attention to news. Few people are able to connect macroeconomics and long-term investing as well as she does. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you, and enjoy the video.
And like all day today, they've had wires offline because of some technical vendor issue. So just can't send wires. Just money's just stuck in this little controlled pocket. Whereas Bitcoin's still putting out blocks, still working. There's always drama around it, but it's still working. And I think that people forget about that. And I would say that as far as this whole kind of corporate centralization thing, none of that impedes Bitcoin from working. It's not even at the current time raising fees. I mean, that one of the concerns, obviously, when 10x more people want to use Bitcoin, there could be fee pressure on the main chain, which could elevate smaller users to higher layers of the network, which has trade-offs. But at the current time, you have kind of the perfect world, which is that there are these big pools of capital buying it, and yet it's a permissionless network. Anyone's free to use it. I would like to see more people, directly use it. I would like to see more retail buyers buy it and take self-custody of it. I invest in businesses that try to make that possible and encourage it. So I always like to see more of that. But Bitcoin works. And I mean, if people are concerned around MicroStrategy buying or BlackRock buying or governments buying, basically what they're saying is that the weakness of Bitcoin from large entities, like the way that they want to kill Bitcoin is to buy it. Like if that's Bitcoin's weakness, if large entities buy it and that hurts it, then it was never meant to be.
Yeah.
I look at metrics like, because it's proof of work, not proof of stake, I'm somewhat less concerned around ownership concentration. It still affects price potentially, but I'm more concerned around market functioning. So I look at things like miner centralization, miner supply chain centralization, mining pool centralization, things like that. Node distribution, stuff like that. Less around the custody aspect. And in addition, so a lot of people are also concerned around stable coins eating into Bitcoin's market share for payments, which one, it's not taxable for the most part. So entities gravitate toward that. And also for people that are using it as like working capital, so savings for like 3 months that you're going to send around and receive payments. People, a lot of times, especially in emerging markets, people spend in a month what they made in that month. They can't risk a 10 or 20 or 40% drawdown, which Bitcoin can do sometimes. So they have like these working balances. But part of Bitcoin reaching that level is when more and more entities own it, and it's 5 times larger than it is now. And you can't have like a single like FTX in the Bahamas blow up and then send the price around, affecting everyone's money. So part of the maturation process is that more entities buy it. That'll include small entities, big entities, potentially sovereign entities. Pretty much the whole stack is buying it. If it ends up being a global reserve asset and a global reserve money, it basically means everybody's going to own it in some way or another. Now, the path dependence still matters. The ideal, optimal, the utopian scenario is all the little people get in first, then the bigger people come in, and like nation states are last, right? You don't want like Apple to come out and buy, and become the biggest Bitcoin holder after they've already kind of played the fiat game really well for 3 decades, right? But as a permissionless network, you can always choose who figures it out earlier. That's why a lot of us engage in education. Most people here are they have platforms or they individually work with people. to help people learn about Bitcoin, self-custody Bitcoin, just relentless education to try to get out there and say, hey, before companies come in and just bid up the price to, multiple six figures, try to learn about it and buy some.
The current institutional adoption wave, spearheaded by financial giants like Fidelity and BlackRock, is only the next stage in Bitcoin's development and does not stray from its initial goal. Decentralization can continue to expand not only in terms of who owns Bitcoin, but also in terms of how it is mined, stored, and enhanced at the protocol level, as long as regular people remain active. Near the end of her talk, Lynn Alden raises one of her strongest points: privacy. According to her, privacy should not be viewed as suspect, but rather as the standard in a genuinely sound financial system. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
I would be concerned if their debt levels got relatively high. It's hard to measure exactly how high too high is, but generally speaking, the more debt there is relative to their equity and their Bitcoin, the more of a chance that they could run into a bear market problem. Now, they are terming that out pretty significantly, so they're doing calculations to basically say that Bitcoin would have to be in more than a 4-year bear market for them to run into serious trouble, where they'd either have potentially trouble refinancing their debt, or having to sell Bitcoin in order to meet their obligations. But that is one of the negative scenarios that could happen, is if they get over leveraged and Bitcoin enters a longer than normal bear market. Other potential tail risks are hack risk. As far as I know, they diversify their custodians. I haven't kept up on all of their filings, so I don't know if that changed or if they moved that around, but I know historically they had 3 different custodians that they used. So forgive me if I'm not super up to date on what they're doing with that. And also tail risk of, it's a giant honeypot. If the U.S. government has a problem, they know where the Bitcoin is. Same thing for, BlackRock. So Bitcoin IOUs are not the same as Bitcoin. So I think that I think they're doing the right strategy for them. And I understand concerns that people have around concentration, but it's an open protocol. They're buying a lot. They said they're going to buy a lot. They are buying a lot. Others have had 16 years to stack. They still should be stacking other people. So I always like to see more diversified Bitcoin holdings wherever possible. But basically, I would say the most reasonable risk is just debt terms relative to the market cycle, which so far they've navigated, but it's always a risk.
That's fair. That's fair. Well,
one thing I would add real quick, because I see in the chat people talking about centralization, I would point out that GBTC had more Bitcoin at their peak than MicroStrategy has now. So MicroStrategy has 500,000 and change, whatever the number is. Grayscale had comfortably over 600,000 at their peak before the ETF conversions allowed all the Bitcoin to drain and go to cheaper ETFs and places like that. And then if you go back really far, places like Mt. Gox, the percentage that were trading on one exchange in the early days. So I would say people that are concerned here in 2025, if they weren't equally concerned in, say, early 2021, late 2020, just keep that in mind, that there are these pockets of centralization that happened. Potentially a bigger issue is just how many coins are sitting at Coinbase, because a lot of these entities all use Coinbase for some or all of their of their custody.
Lynn Alden concludes by offering a dark but fair assessment of Bitcoin's current state, paying particular attention to the function of organizations such as MicroStrategy and the dangers associated with centralization. She admits that Michael Saylor's efforts to create a corporate Bitcoin treasury model are not novel, but they are finally gaining traction throughout the world, with businesses like Metaplanet in Japan following suit. As long as it is lawful and handled properly, she thinks this tactic can be effective in other currency zones. Alden warns, meanwhile, that there are special hazards associated with being the largest player. A company's exposure to market cycles, debt obligations, and liquidity limitations increases with the size of its investment. For instance, MicroStrategy may experience severe financial strain if they take on excessive debt, and Bitcoin experiences a protracted bear market. She also emphasizes the significance of custody, or the location where Bitcoin is kept. A central point of failure is created when too many coins are held by one custodian, such as Coinbase. Alden's closing remarks, however, may have been most impactful when it came to privacy. Privacy should be the rule rather than the exception in a really free and healthy system. But in today's financial environment, requesting privacy is sometimes seen with mistrust. Even totalitarian authorities couldn't keep track of every transaction until the advent of modern technologies, she explains. We've reached the other extreme today, where people are made to feel weird for requesting even the most basic anonymity, and digital finance is based on surveillance. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.